Hey, everybody. Thanks for checking in Sunday night here on our TDR Small Cap Sunday podcast. I'm your host, Shad Dales. 5 new companies this week to give you information on stocks that you may or may not know about. So we're going to dive into it here tonight, including, once again, our cannabis pick of the week. This week, multi-state operator Curaleaf. What do we like about this stock? Well, let's jump into it. Welcome in lead financial writer and analyst, Bill McNarland. Happy Sunday evening. How was your weekend?
Oh, I had it fabulous. It was beautiful weather. It was great to be outside and happy to be here, though. I'm excited about this show.
Good time of year, is it not?
Yeah, for sure.
All right, tonight we set our eyes on 5 new companies in the small cap environment that's grabbed our attention. And we're going to focus here tonight on one precious metal company, 2 biotech companies. We're going to actually do some comparisons related to that. We're also going to, as I said off the top, focus on multi-state operator Curaleaf and be curious to see some of the things that you pulled out from there, obviously, Bill, and some of the things that you like about this company. But as usual, all views of the TDR Small Cap Sunday podcast, the guests on this podcast are purely opinion. You should not treat any opinions by us or our guests as investment advice. Bless you. The views on this podcast are solely intended to be informational and are not investment advice. All right, Sunday night, 5 new companies. Let's jump into our first company based out of Monterrey, Mexico, however, operates in multiple countries. A company called, is it pronounced Andean?
I believe so. Yeah, that's what I heard on
Andean
their
Precious
analyst call.
Metals, trades on the TSX Venture under the ticker symbol APM. Current share price 99 cents. Current market cap is 149 million. Shares outstanding are also 149 million as well. And daily trading volume really low right now at 18,000. This company is in mature stage. So, Bill, as I said, company operates in the Golden Queen mine in California and also has an impressive processing facility in Bolivia. So you want to explain what they do and what impresses you about this company and the opportunity it presents?
Yeah, when you get to become a mature company, you actually
Yep.
have production, which is rare amongst the whole mining sector. You still have ore, and then you have to process it into something better like silver. And so what happens is you have the option of shipping that off to a processing plant, or some companies build this themselves. And what's interesting about this company down in Bolivia is they have the capacity there, and it's much larger capacity than what they have for their mine. So they're actually a service provider for the industry around there. So it's kind of like almost like an oil refinery. You take a
Yep.
raw product and you turn it into something nice. What's interesting about this is the revenues that come out of this is rather stable because the price of your input and output will jump around, but they are correlated. So they're really in a spread service business. And in addition, they have the mining operation as well. So it's a nice complementary way of having a lower risk mining investment.
Any idea if it's difficult to do business in Bolivia?
Yeah, Bolivia, I took a look similar to the statistics that we look for the other countries. It was a little bit more difficult than doing business in Colombia, but that we talked about last week or the week before. But the reason for it is not really a concern. Where it had lower ratings was the difficulty in getting credit when you're banking, dealing with the tax authorities. But
Okay.
when you have your own capital coming in,
Yeah.
you're not worried about that. And secondly, being a large organization, you have professionals to deal with the tax authorities. So I don't think those concerns are really too valid. But what really caught my attention, and other investors as well, they have a 14% investment by Eric Sprott, the famous individual that understood
One of
mining
the biggest mining
very,
investors
very
in North
well.
America. Yeah.
Yeah, and they have 5% ETF money, and then they have insiders own 53% of the company.
Impressive.
So these are a lot of smart individuals that aren't concerned about the risk of being in Bolivia.
Okay, well, let's look at some of these numbers to go to the charts. Let's first start with their balance sheet. Like, what are you seeing? And I guess in a lot of ways, too, is there, we all know there's risk always involved in this space. So, what is the risk that you're seeing?
You want to de-risk as much as you can. So if you and I wanted to go out and spend a couple $100,000 and try to create a mine, there's a lot of risk there. But what's interesting about this company is it has a market cap of about $150 million, but the breakup value after depreciation has come off is around 180 million. So there's a lot of assets here. So instead of starting something new, it's intriguing to consider buying something like this. But they are strong financially. They have 146 million of working capital, which is almost similar to the market cap, and they're cash flow positive. And because of this, they're adding value by actually buying back shares. And so last year, the company bought about 3.8% of the float back from investors. So then investors are getting a bigger portion of the pie.
So what are investors missing here then?
I just think it could be potentially the jurisdiction. People, just like we saw a couple of weeks ago when we looked at a mine in Colombia, a lot of these producing mines are real screaming value right now, and that's why they're coming up when I'm going out to look for excellent values.
So what'd you say again for working capital? What are you
Yeah,
seeing?
the working capital is $146 million, and their market cap's 149.
It's
So the
crazy.
company is only available currently for the price of its working capital.
Credit scores currently?
Yeah, the credit score is 8 because of this. So it's very high because they just have so much well-funded cash and so much assets as well.
Hmm. You want to walk us through too the importance? Like a lot of people, obviously, retail investors know about share buybacks, and they always love it when they see share buybacks when it comes to executives within this company. But what can you report? And what did you see pertaining to this company in particular?
Yeah, they bought back 3.8% of the float. I prefer this even to dividends. I love shrinking the pie. And so, of course, everyone gets, upset when individuals dilute a company.
Yep.
But this is just the opposite. Your share of the pie is getting bigger every year, and it's more tax effective for investors than dividends because they don't have to pay tax on adding value like that. And so, this is really impressive when you see a company buying back that amount of shares.
All right, let's now focus on our next chart, which compares the income to cash flows, which at first glance is showing that it was a challenging year for the company. Why was that?
Yeah, so they had two things happen. They had a fire in California, so part of their key processing equipment was out for a couple of months. Also, they had unusual weather in Bolivia, which slowed down some of their production as
Hmm.
well. But still, even though that this is a challenging time, they are very undervalued what we see. So we look at this chart here, reminding ourselves that the market cap's 149 million. They had a revenue growth of 43%. And when you go down, you got to love these, charts about SG&A. You don't have to brand or try to make fancy the production that you have. It's a beautiful thing. Silver is silver, and gold. But their 4-year average EBITDA is $25 million. So
Strong.
it looks like it's trading at about 6 times EBITDA, which is very attractive.
Very attractive. Well, whether you believe in global warming or not, the weather doesn't lie, right?
Yeah.
Finally, let's look at now their cash flows, which could be up and down, knowing how bumpy I guess this industry can be year over year. So, what is their current levered free cash flow?
Yeah, so his our 4-year average is $18 million, and that's why they have some money to be able to do different things. And we want to make sure that mining companies are reinvesting back in. You don't want to kill the golden goose. So they invested 12 million in capex last year, and then they had the share buyback of 3.8% of the float. And so this is a very good use of a strong cash flow company and the funds that they have.
Get your green check mark out because I'm going to ask the question: would you own this stock? And it appears yes.
Absolutely. I think this also shows that mining doesn't have to be the speculative risk that people think of when mining. So we've saw a couple of examples of this now that you can find some excellent opportunities that have lower risk than what we think of with mining.
All right, on to company number 2 here this evening, which is a biotech company. We're actually going to switch things up a bit. These next two companies are actually biotech companies. We're going to do some comparables. And really, before we go into company specifics, we want to talk about just things you need to know when investing in the biotech industry, which I think some people can understand. It all comes down to burn rate, the amount of cash flow they have, how far along they are with drug development, all those sorts of things. But first company we want to look at is a company called Aadi Bioscience, trades on the NASDAQ under the ticker symbol AADI. Current share price $1.43. Market cap is 35 million. Shares outstanding are 24.5 million, and daily trading volume is 377,000. So as I said, before we get into this, let's educate our audience a little bit. We've had some people reach out, asking us questions over the last couple of weeks pertaining to a lot of these companies in the biotech space. And first wanted to bring up the idea, what should one bill consider when investing in the biotech industry? Like what comes to mind?
Well, first of all, there's a lot of opportunity. There's about 500 small and micro cap biotech companies in the US,
Yeah.
plus about 28 more when you add some of the Canadian names in there. So there's a lot of opportunity. But we just want to have a process. You and I aren't doctors, and we're not going to pretend that we're scientists as well. But as an analyst, you can look through some basic things that'll make it easy to compare the type of risk and reward of companies. And that's why we're going to look at two today and decide which one we would prefer as investors.
Okay, nicely said. So saying that, so what should we consider when it comes to drug development or an already established commercialized drug?
So that's the first question we want to have
Yeah,
is, do they have drugs that they're selling currently that are approved? If not, where are they in the process? So it's a five-step process in the US. First of all, they typical will do some research enough that they can put a new drug application in. And this is where the FDA is looking into the initial research to see if it's dangerous for people. Then you get approval for a phase 1 trial, and that's with healthy individuals that don't have the condition you're trying to solve. You're just testing for safety. And then in phase 2, a small group of patients that have the issue that you're trying to solve. And then stage 3 is a larger sampling of people that have the condition as
right.
well. If you're successful, you get to put a new drug application in and you wait for approval or feedback from the FDA. If there's an urgency for the medicine, there's potentially a fast track system. But if not, this can actually be a decade long process.
Of course.
It's not quick. So we have to make sure the company has enough liquidity to be able to get to the next stage, to excite investors, to raise more capital, or to do some type of joint venture or get some debt. So that's what we're going to be looking at when we compare these companies.
Okay. Well, that makes sense and segues into my next question, knowing it does take time for a lot of these drug development companies in the early stages. So, do these companies have enough capital? That's the most important, I guess, next question that should be asked, when investing in this space.
Yeah, and then we're going to be comparing that to the burn rate, making a projection on the burn rate. And then they're not going to have enough capital today to get through the whole process, but we want to know, do they have enough capital to get to the next stage to
Yeah.
excite investors?
Yeah. All right. Total addressable market when it comes to the potential of the drug if it is approved. That's another important question.
Absolutely. Yeah, we'll look at that as well.
Okay. So, saying all this, what is the focus for this company in particular?
Yeah, so for this, it's a certain type of cancer. What sets this company apart is they actually have an approved drug, and the total addressable market for themselves, and they're the only group that's in this area, is about 16,000 new cases annually of this form of cancer. So this is unique. When you look at a small cap or a micro cap, in this case, biotech company, they have an approved drug. Plus, they have other drugs in different types of phases. So that's very unique.
All right. Let's go to the charts now and let's look. How has this stock performed recently? What are you seeing?
Well, it's been crushed. And so this is
Okay.
interesting. So they did something similar to an IPO in August 2021. They did a small little bit of a merger with a previous public company, did a financing of $155 million. It was very interesting. In the press release from August 2021, it listed 10 institutional investors that had came in. They were very confident. People got excited and the stock ran up to $29 in the fall of 2021, and now it's down to $1.43.
Big difference.
So that with biotech, this
That's
is
biotech for you.
swinging for the fences.
Yeah.
The stocks can go up like crazy, and they can also come down through time as well.
Okay. Next chart I want to look at when it comes to their current drug pipeline. At what stages are they currently at?
Yeah, so they have one drug that we mentioned that is already approved and that they're selling and ramping up sales on. And then they have another drug that's similar but trying to solve something related but different that they're going into. They're into their phase 2 with. And then they also have ones waiting to get into phase 2 as well. So they have a pipeline and they also have something in the marketplace right now.
So just to keep in mind when we're comparing the two companies right now, that they already have a drug that's being commercialized and they're in a phase 2 trial. So remember that when we compare this to the next biotech company. Okay, let's go to balance sheet now. What are we seeing as far as revenue over the past 12 months?
Yeah, so here on the income statement, they have $23 million worth of revenue last 12 months. So that's interesting. They've had 27% growth. So this is still, they have to go out and educate doctors, talk about it. So it takes some time. It's not instant that you get the revenue, but they're outbuilding revenue. But you'll notice that their EBITDA last year was minus $74 million still. That's because they had a $51 million spend last year in the last 12 months on R&D. That's with their other drugs that are in their phase 2 studies and the ones that are going to be coming there. So they're actively still investing quite heavily in this business.
Okay, so what's their current working capital?
Yeah. So we look now at the chart here for their balance sheet. As a reminder, they have $35 million of market cap and they have working capital of $82 million. So you'll see this often with biotech companies. And sometimes you're like, wow, this is so exciting. They have three times the amount of capital or cash compared to the market cap. But remember, this is going to go down as they're burning through. So they don't have a lot of debt on the balance sheet. That's something to note too, because
Yes.
debt's an option for them to access, but they have a negative leverage free cash flow of about $61 million. So this tells us in the next 18 months, they got to make a plan.
Okay.
One, their phase twos can go a little bit further to cause some excitement,
Yep.
but they can ramp up the sales on what's already there. So they had a good growth rate, but if they get the word out more, they can solve part of this problem with that. And also, they could potentially take on some debt or they could do some joint ventures or whatever. They have to do something. But this is actually a pretty good situation for a biotech. You can see what potentially could come in the next 18 months. And so, this is something that is actually fairly positive when you look at biotech companies.
Okay, so before I ask you whether you'd own this stock or not, let's now compare it to our second biotech company. It's a company called Aprea Therapeutics. It actually trades on the NASDAQ under the ticker symbol APRE, and a current share price is $3.95. Current market cap is 21 million, and shares outstanding are 5.4 million. Daily trading volume is again low at only 44,000. So same process as we did with the first company with Aadi Biosciences. First up, what is the company's focus here?
Yeah, so they're again, it's also cancer that they're
Yep.
working on. And what was interesting about these two companies, they have similar size market caps. So I thought it was a very good comparison between the two, and they're kind of in the similar area as well of what they're trying to do to help others.
Okay, let's go to the charts again. How has this stock performed recently? What are you seeing?
Yeah, yeah. So they came out in an IPO in October 2019. The equivalent, the stock, it was $300, but post rollback, it would be $15 when we're looking at it. And the stock almost hit $1,000 a few months later. So that was a wild times. Right away, people got really
$1,000.
excited. Yeah. And so this is, we can see this on the chart. There was that quick run up there.
Yep.
Um, but what happened was late. Remember, they IPO'd in October 2019. By late 2020, they were very excited shareholders. They found out they got fast track approval for a drug that they had in phase three. But then only about a month later, the data came back disappointing.
Which is huge.
And they had a press release that, and then the stock just got hammered. And you can see where the excitement was a fast track,
Backbreaker.
phase three. You understand. So the stock dropped 70% on the press release.
Yeah. Can't
Yeah.
there's no way around that. The data doesn't lie, and if that's what it is, then that's the risk that you take, obviously, with biotech when you're swinging for the fences, right? And
Yeah.
I do know that there's a large percentage of small cap companies looking in the, break it through the biotech industry. I think it's like 99% fail. So as much as we are swinging for the fences, it's proceed with severe caution when it comes to a lot of these companies. Okay, this company's starting early, and do they have enough working capital to support it? Like, what's their current burn rate?
Yeah. So right now they have a phase one in progress, a phase one starting, and they're working on something preclinical. So they have a long time to be able to get back into the game again
Yeah.
because they're so early stage. So you ask a great question about the burn rate. Well, what is interesting though, first of all, they just did a capital raise in March. And they raised an agreement for 34 million, of which 16 million came up front. And it was institutional investors in healthcare that allocated to it. They didn't disclose the names, but they said it was institutional. So this brings their current working capital to $30 million currently. But last year, or in the last 12 months, their EBITDA loss was almost $14 million.
Okay.
Leverage free cash flow was negative 13 million.
Yeah.
So I think they have about 2 years worth of burn until
I
they
was
have
gonna
to do
say.
something. But they're in phase one. So this is still a story that's going to take some time, and I don't feel excited about them only having 2 years to provide value again.
So what happens to a lot of these companies in this, like, time? Do they have to spend the capital they have? They look at obviously further dilution and raising more money. Like, what are some of the, I guess, options and scenarios that usually play out at this stage, knowing
You
that
know,
not a lot of working capital and it's still in an early stages as far as trials are concerned?
a lot of times, the companies will go and raise more capital, but
Yep.
often your price will be down, so it's not that wonderful for investors. There is potential of some debt, but the debt, if the appetite is there from debt holders, the other thing you can do some types of mergers, acquisitions, joint ventures, but a lot of times I was doing some research, and what really happens is a lot just kind of go dormant.
Yeah.
These companies end up going very, very quiet. Maybe someone will come take a look at it. Um, some of these companies, with the amount of working capital they had, you'd almost kind of wish they say, if this isn't going to work, let's just wind this up and return the money to shareholders. But that doesn't typically happen. Usually they just
Be
keep
nice.
going. They're passionate individuals that are going to keep going. And that's where I'm going to say one cautionary statement as well. No doubt all of us have had someone in our life that's had cancer
Yeah, of
or a
course.
different condition. And we want to be careful not just to invest in something that's close to our hearts.
Of course.
We want to be careful in taking these first steps to try to understand where the company is at.
Okay, so moment of truth. Let's wrap this up as far as the second and third companies. Which company would you own? Like, it's pretty clear the first company that we've outlined further along, commercialized drug, more capital, less burn rate. Clearly, these are important things to think about when entering into the space, but a great walkthrough as to why you would probably own Aadi Biosciences versus Aprea Therapeutics.
Absolutely. So that's going to be our decision. So when it comes to biotech, how the institutions do it is typically they invest little bits in a number of names.
Okay.
And this is the process I would go through. You want to have some biotech in your portfolio. Look at different names, try to find the ones that are stronger and then allocate a little bit of capital. And that's what we're going to be doing on the show is trying to find some names that we can add a little bit of capital to.
Okay. Well said. All right, three down, two to go. Let's now jump to our fourth company this evening, which is a high-tech printing company called Arc Document Solutions. Trades on the New York Stock Exchange under the ticker symbol ARC, based out of Oakland, California. Current share price $2.92. Market cap is 126 million. Shares outstanding are 43.1 million. So a tight share float, and daily trading volume is around $275,000. So, Bill, as I said, it's a high-tech printing company. I know a lot of people ask, well, okay, that's a high-tech printing company, but how exactly does it work and what exactly does it do? So you want to explain further?
Yeah, so this is a mature company. The business they're in, high tech printing. If you go to a conference, you go to the airport, you go to the mall, there's going to be big displays inside of stores and such, and those are all printed. There's a barrier to entry because not a lot of individuals can do this. But I took a look at the growth of the industry. It's not really large. It's a mature area. The CAGR is supposed to be around 4% growth.
Okay.
But they have clients like Nike and
Yeah, I was going
Chevron and
to say.
Starbucks, Westfield Malls, Netflix. This is a business that's well established, but it's a mature business. And I want to talk about how we don't always have to have exciting, fast growing companies to be good investments because there's other ways that there can be shareholder value added.
Well, you said not a lot, not a big industry, but those are some big clients. Starbucks, Nike, Chevron, Netflix, just to name a few. So how has the stock performed recently when we look at the charts?
Well, we look at the chart here. It's interesting. The stock has really been challenged. We can see that it's way off back from its IPO in 2005.
Wow.
And it's been a slow time from this year. The stock has been rebounding,
Yep.
but this is a longer, older story. And I saw some things that we'll talk about coming up here that I thought were really interesting.
Okay, so how's the company doing financially? If we first look and review their balance sheet, like what was the revenue from last year along with their growth percentage?
Yeah, so the balance sheet was really strong. They had a lot of working capital, $38.5 million, and reasonable debt levels of about 50% of the assets. But regarding the income statement, like you asked, they have a market cap of 126 million. Let's remember that revenue of 285 million, but they have good margins in this, and that showed how they have a niche. So they have a gross margin printing, a gross marginal profit in printing of 33.3%. And the SG&A is only at 26. So they have some good margins here in
Right.
the high value work they do. But their EBITDA was $30 million. So keep that in mind. their EBITDA was only, the stock's trading at 4 times EBITDA. So
Right.
this shows that there was a lot of nice pricing here.
Okay, so next chart, let's dive into that and what they're doing with all that cash. First up, levered free cash flow is showing what?
So they had about 24.8 million in leverage free cash flow. So what are they doing with all of that cash? And this is where I thought it was very interesting. They're buying back shares, 2.5% of the float last year. So that's really good for shareholders. They're paying a dividend of 6.8%. That's nice use of cash flow. And the CAGR, the 3-year CAGR on the dividend's been 71% growth. So it's growing dividend, but they are reinvesting in the business. They had a capex budget of 11.5 million last year, and they're spending R&D of 7.1 million. They want to go back to growing the revenue,
Yeah.
but they're giving back to shareholders. But this is where it got really interesting. And
Okay.
I remember a conversation from the year 1999 during the tech bubble, and so I was told something which was unbelievable. Thinking about, individual, very smart, said, why would you consider investing in an internet stock that's way up when instead you can buy a broom company that is using the internet to sell more brooms?
Okay.
And so it's using these tools. So they're investing in AI.
Hmm.
And so they're using AI to make things like scanning a lot more efficient. They're
Okay.
using it also for their marketing. They're using it for all their internal systems as well to improve the products and their service to clients. So this is part of what they're spending their R&D on. And so I like this. Instead of just looking at an AI name like NVIDIA or something, look for companies that are using AI to grow their future revenue. And so this is something I was very intrigued by.
Cue the AI trend, and with so many companies putting this in their names right now. But be careful, obviously. But I think the most important thing, as you said, comes down to the balance sheet. What are you doing EBITDA wise, revenue wise, levered free cash flow wise? There's a lot of small cap companies right now that are jumping onto this trend of adding AI into their company name. Because we actually had an example a couple of weeks ago about how there's a company that's pretty much done nothing the last couple of years, but has a trading volume north of 4 million on a daily basis, all because of the word AI in their name. But outside of that, there's really nothing there for the company. So, moment of truth, would you own this stock?
I like this because you don't have to necessarily be fast growing. They got a plan, and they're buying back shares. You're getting paid dividends. They're investing in R&D and capital expenditures for the future. This is a name and an entry price I like. And this also goes back. You don't have to rush into an IPO. The IPO was in the year 2005. You're better off waiting till today, almost 20 years later. And now I think this is the time that I would be very interested in buying.
Where does time go? That's almost 20 years ago now.
Yeah.
2005. All right, time for our final company this evening. It's our cannabis pick of the week, multi-state operator Curaleaf, which is arguably the largest company or cannabis company in the world. A lot of people know about this company. It operates in lucrative states like Florida, Ohio, Pennsylvania, along with New York, as they see this as a big wholesale marketing opportunity. Like there's a lot of companies that are leaving New York, but if and when this ever does right the ship, it's going to be a huge opportunity, but that's years down the road. But needless to say, they have outlined before in the past that this is a big opportunity for the wholesale market, especially when you factor in the amount of illegal black market dispensaries in Manhattan alone. So, first up, as we do every single week, we walk through our audience through a 7-step experiment on whether this is a company you would own or not and the value pertaining to it. So, first question, as we do, as we go to the charts, what is their current revenue growth?
Yeah, so their revenue growth over the last 3 years has averaged 29%. They were right there with their fellow competitors, growing quickly. Slowed up this year, along with the median. They're at 3.1%. But I do see a plan here for growth, especially the international expansion they're making a plan for. So I think that number is going to return to a higher level than they have been in the last year. But they're in line, and I think they got a plan to start to grow again.
Yeah, good point. I did outline some of the key states that they operate in, but they have probably the most extensive, one of the most extensive international, I guess, plans, so to speak, versus any other public company, especially in the U.S. market. But I know that there's a few Canadian companies with some strong European international presence as well, but that's definitely a focal point for Curaleaf. All right, second question. What did they report last year when it came to gross margin along with SG&A?
So this is interesting on the gross margin. They've slipped back a bit, down to 45.5%,
Yeah.
which is lower than their competitors in the benchmark. But what I like to look at often is the gross margin, but also the SG&A. And actually, on the SG&A side, they're actually leading and they're dropping more than the median, and they're bringing that down. So they're running a really tight ship on the SG&A. Gross marginal profit is a little bit different, but when you combine those together, they're right there in the median of the stack of their competitors.
Okay. Third question: Who's or what's the current status of their liquidity?
Yeah, so this is something that gets brought up a lot. People just simply review current ratios without looking at something that's very important. And we had an article about this that came out on Friday earlier in the week. So when you're looking at the current ratio, you can see that it looks like their liquidity is a lot more challenged than their competitors, and that it dropped a lot last year. But then the second thing, when you see this quoted, you have to look, do they have debt that's up for renewal this year? Because that then shows as a current
Yep.
liability if
Yep.
it's less than 12 months. They have $136 million of long term debt and capital leases in this year. The debt markets are quite healthy right now. So I have no
Very.
concerns about them rolling over this debt. So I think when I see, and I see this on LinkedIn quite a bit, people are just comparing MSOs and their current ratios. You have to add the debt renewal to take a look at to fully understand this number. So I think this is actually a false warning of concern for Cureleaf.
Okay. Good to know. Fourth question: What is their leverage showing?
Now, but truly on the balance sheet, Cureleaf has more leverage than their competitors. This is not necessarily good or bad, but this tells us if you're looking for an MSO,
Yep.
this is a higher risk, higher reward level of leverage than their competitors. So that kind of guides investors in deciding what type of MSO is appropriate for them.
Okay. Next up, fifth question: levered free cash flow margins, which, according to you, that if you were allowed to pick one metric to track financial progress in this space, this would be it. Why is that?
It's simple to understand. When we talk about a family budget, you want to see every month that the cash in the bank is growing, similar to companies. And so I like this one. Cureleaf is just like the many of the other MSOs. This year they have went cash flow positive,
Yep.
and so that's something very exciting. And they made a huge difference, 13.8% in the raw number they increased. And so just similar to their competitors, they're moving into this cash flow positive. That really de-risks a company when there's positive cash flow and you're not worried about having to go to refinance or add debt to keep your operations going.
Right. All right. Second last question, which is our sixth question, and it's expansion time. What does their current capex look like and outline?
I was a little surprised by this one. So they're actually lower than the benchmark, but I have a suspicion this is going to change with their international expansion that they're going to be adding to this number. So I think when we look at this next year or in 6 months, they're actually going to be at the median or a little bit higher because I know they're going to be reinvesting back into their business with their international expansion.
Yep. All right. Moment of truth. Last question. There's a lot of stuff on the near term horizon for this industry, as we say each and every week, related to rescheduling, possible safe banking, among other things. And right now, these current share prices, earlier this week, one day alone, there was less than 2 million in trading volume amongst the top 5 MSO companies in this space. Is this a stock that you would own? If so, why?
I would add it to the collection of cannabis stocks to own. And then I like the diversification that comes from the international expansion as well.
Yep.
And so I think this is a good component to have if I look for an investor looking for a cannabis exposure.
All right. All right. That wraps up this week. Good stuff. And anything on the horizon? I know they were going to be initiating coverage. Our latest is Jushi Holdings that's going to be coming out. Is it this week, if I'm correct?
No, it came out already.
Oh,
And
it came
so
out already.
you can go
Okay.
on the website. It's up on the website and it's released. So take a look at that. And then we're going to continue on with our articles on analysis. Those have been popular. So next week we'll have 5 more of those that come out. But I think something to take a look at. We just had this discussion about the current ratios and the misunderstandings.
Yeah.
This is so widely quoted on LinkedIn and different. And I just think it's misunderstood. So take a look at that article that I wrote that I put out on Friday.
All right, we're putting out stories every single day leading up to earnings, which is next month, August 5th, when GTI reports their first earnings. But like just things that really you need to understand and look forward to as we enter this new era of this industry and the mature growth stage. So some highlights this week, as you said, as I indicated before, if there was one metric to basically track when you're making, I guess, a decision or as an analyst within this industry is financial progress in this space. But these are some of the stories that you're basically printing out every single day. And if you want to learn more about this stuff, greatly explained, log on to thedalesreport.com, or as well, click on the QR code below and subscribe to our Baked In newsletter to get all the latest information that pertains to the upcoming earnings season as we release stories every single day over the next 30 days. In the meantime, sir, good stuff again this week, and enjoy the rest of your weekend, and we'll check back in with you early next week.
Yeah, chat soon. It's been great.
All right. Thanks, Bill. Hey, everyone. Thanks again for watching. Hey, we're humming along, and it's all because of you and the audience and community that we're building. So, again, make sure to smash on that like button and leave lots of comments. Who do we have up next? You let us know. Who should we interview? What companies? Is there anything you like? Is there anything we're missing? We're all here for you. Let's get on with each other and build this community for all of us to benefit. As usual, don't forget to subscribe to our channel because in the end, we wouldn't be here without you. Thanks again, everyone.